Hey everybody, welcome to this week's podcast. My name is Will. I got Joseph with me. We're going to do another three charts of the week type of review. And we're going to get right into it and really kind of on an odd day. We're recording this Thursday morning, May 18th, about 10:40. Markets jumping pretty considerably after the run that we saw yesterday afternoon, following some follow through or potential conclusion about the debt ceiling. But what we want to get started with is this like value growth spread. And Joseph, you put a piece in the report. If you want to tee this up for us, we'll throw the image on YouTube now.
Yeah, so just looking at the rolling 6-month performance spread between VUG, which is the Vanguard Growth ETF, and VTV, which is the Vanguard Value ETF, that exceeded 20% in favor of growth last week on May 10th. Excluding clusters, which just means occurrences within 3 months of one another, this is only the sixth time it's happened, going back to, I think data on both of those funds goes back to 95. So, pretty substantial amount of history there that it's only happened 6 times. Some of the other dates in there, I mean, half of them are from, what you would kind of reference as the dot-com bubble era, twice in 99, once in 2000. And then the other 3 occurrences have happened since 2020. So had a pretty much 20-year gap between those occurrences between the April 2000 and then November of 20. Then we had November of 21 and then now May of this year. So just massive outperformance from growth so far this year. And we've talked about a lot of it in our research that, the mega cap stuff has just, done so well. People are like the S&P 6 or 5 or whatever you want to refer to it as. Just the mega caps have pretty much carried this market higher. The breadth has been relatively poor for some of the moves that we've seen. I mean, you can just look at the performance between the S&P equal weight and then the S&P cap weight. The S&P cap weight's up, a little over 7%, I think. And then the S&P equal weight's around flat for the year. So, huge discrepancies there, and then huge discrepancies between growth and value. A bit mixed on the forward returns, at least looking at the growth returns. So VUG forward returns 1 year out, the average is down 3%, but you didn't have one occurrence where it was less than or greater than 10%. So you had 24% positive, down 12%, down 33%, up 36%, and then down 30%. So some pretty outsized returns anytime this has happened. On the other hand, value really didn't have any. It had one really good return period, which was November of 2020. The forward returns there at 35%. But other than that, you really didn't see any outsized negative or outsized positive returns that would, raise an eyebrow or anything. So we'll see what happens moving forward. I really wouldn't expect growth to continue to outpace value at this rate. We're looking at a situation where either value really starts to pick up. You start to see, something like the S&P equal weight start to pick up steam over the cap weight, or we're, near some point of a reversal in terms of just the market moving higher. So one or the other. I would say I don't think you can keep going at this rate for a little while longer, but it's not something that's necessarily sustainable over another 6 months.
Yeah, and even I know just looking at the returns at the bottom, you mentioned the averages for growth value. Value tends to do a little bit better on both the average and your median return. That would coincide with the spread and getting this high, seeing some mean reversion come back into the value camp. I know we're technical guys, but what do you think could be some of the catalysts that got us to this extreme spread for growth?
Well, I mean, there's a few things. I mean, I think part of it is because growth, especially the mega cap growth stuff, lagged so much last year. Where the
just a mean reversion,
really kind of more.
Yeah.
It's somewhat of a mean reversion, but I also think, other people have talked about this. You get these rebalance, these automatic rebalances from passive investing. Mike Green from Simplify has talked about that a lot in his research. I think that does have something to do with it. When, last year you had rates moving a lot higher, people were forced to, in their 60-40 portfolios, when they rebalanced, they had to sell equities and go buy bonds. Mm-hmm. And that dynamic is going to, when people are forced to sell equities, typically broad indexes, it's going to have the biggest impact on those mega cap names because they just make up a larger portion of those funds. So I think we're seeing a bit of a reversal with that. Rates are kind of off their peak from, October, November of last year. So some rebalancing there. And then I think kind of continuing through this year, you're just seeing, trend following, stuff like that kind of add fuel to the fire, at least earlier this year. And then you get to March and you have the regional banking situation. And I don't think anyone really wants to touch a lot of that stuff right now. So there's another kind of like the TINA trade. There's no alternative. And we've talked about too, the mega caps are kind of viewed as safe havens a lot of the time during times of market uncertainty. So I think there's a few factors you can attribute it to, but it's just undeniable that we've seen just some historic performances from those growth names, especially those mega cap growth names.
Yeah, for sure. So that was definitely one chart that we wanted to hit on, pretty defining of the week. If you're cool, we can jump to the second chart where we're going to talk about interest rates, and you just alluded to it a little bit in your last comment. Mm-hmm. But looking at the chart of like TNX, that has been range bound visibly between like 3.6% and 3.3% since March of this year. Earlier this week, we put this on Twitter. Technically, this was a break back into a positive trend. So you got this buy signal on the point figure chart at 3.55%. Today, we're up to 3.6%, which I'm particularly interested in because this is a more meaningful test of resistance, I think, right here. That's been the top of the range since the end of March. I moved to 365. That I think that'd be pretty material here for rates. And then on the downside, you still have 3.3 as a place of support.
Yeah, I mean, I think this also comes back into play. Just the market is pretty. It seems like both bulls and bears when you look at just like if you look at the S&P equal weight rather than the cap weight, and then you see rates. It seems like no one's really caring like, oh, we're going to have definitely higher rates. We're going to have definitely lower rates. We're just seeing consolidation both on the rate/bond front, however you want to refer to it as, and then also just on broad equities. I mean. We'll get into it a little bit. You have some good stuff on the S&P not moving too much over the last 2.5 months or so, and that's kind of carried over to the rate discussion too. So we'll see how this continues to shake out. Yeah, I agree that if we get the 3.65 on those rates, it seems like we will maybe at least get some burst higher. You look at around 3.9 was the December high, and then 405 was the March high. That may be a little tough to get to without pulling back. I think inflation expectations are a bit more anchored nowadays. And I think most people are looking at where either at the end or really close to the end of the Fed rate hiking cycle, right? I think more what we're looking at now is expectations of when they'll cut rates, whether that's, in 3 months, at the end of the year, and another year. No one really knows right now. And I think that's part of the reason why you're seeing people pretty bullish on bonds, and then also saying, well, rates could hang up here for a while longer too.
Mention bonds though, like if you look at AGG, it's actually a notable break today at 98.50. This was also in a trading range, almost like a mirror image of TNX. So this is a notable break to me today down at 98.50, taking out a ton of support. I'm not even going to try to jargon sextuple or something like that.
Sextuple bottom, I guess you can call it.
Point being, like huge support at 98.75. That's now out of the question for the ag. So I think there's maybe something to be said here about the movement in rates. Market's been pretty sensitive to that. So those are two charts combined to one that we want to highlight. Any parting shots before we get to our last chart of the week?
No, I don't have anything else on there.
Cool. Were you teed it up nicely for me earlier, talking about S&P 500 headline index really not moving that much? There's plenty of individual names beneath the surface. We were talking in the office. There's actually a lot of action going on the field, but not necessarily high level. S&P 500 yesterday and today may throw this off, but if we got to the end of this week, it would be the 7th week without a 1% change. So what I mean by that is Friday close to Friday close, you haven't had a 1% change in 6 weeks at the end of this week. So May 19th, that would be the 7th consecutive week. So it's funny that the market's done so much of nothing that it's actually doing something pretty rare right now.
Yeah.
And just to put some numbers to it, so you've only had, if this Friday were to happen, that would only be the 45th time since 1957 that you've had 7 consecutive weeks without a 1% change for the S&P 500. The longest stretch, you went 18 consecutive weeks in 1966 without a 1% week over week change. In the past, we'll say in the past 7 years, the market hasn't gone more than 7 weeks. It's stalled out every single time at 7 weeks. After that, you saw some type of 1% change, plus or minus. So I know that's not really helpful to tell you that the market's going to move one way or the other, but it's the takeaway is just the rarity of the situation that we're in. I know people were talking about 2017. Did happen in 2017. It happened once in 2017 in November 24th, you hit 7 consecutive weeks without a 1% change. But apart from that, pretty rare for this to happen. I mean, we're talking less than 2% of the time the market has done this. I was sharing before, and this jives nicely with just a market anecdote with technicians, where if you get in this really long trading range, you chop back and forth for a long time, you typically see a larger move either to the upside or the downside out of this big phase of consolidation. You see a pretty notable breakout or breakdown is another way to say it. And this data would confirm that. So if you look 3 months out after the market went, we'll call it sideways for 7 weeks, it was either up or down 2% 80% of the time, which is a pretty good batting average to say that it's unlikely that the market stays in this range for this long. And then getting out of this range, you typically see a pretty outsized move one way or the other. That was my monologue for the data that I was working on this week.
Yeah, I mean, it's impressive, right? I mean, we get back to the growth value stuff. I mean, growth's really continue to run. I mean, you look at, the Apples, the Nvidias, the Microsofts, even Amazon has done, really well over the past couple of weeks. But the broad market seems just kind of stuck in no man's land a little bit. So a lot of weird stuff going on. It's hard to say how it necessarily resolves either to the upside or to the downside, with just looking at the S&P. I would expect if it does go to the upside that you start to see some outsized returns from something like the S&P equal weight or value as they, catch up to growth.
Yeah.
Not necessarily a long-term type of deal to look at, but, something that could have an impact over the next, 2 months or so if that does take place.
And it could be
that's
just
something I would keep in mind.
And it could be just a better environment for individual stock picking, because we mentioned like Walmart's up over 2% today on earnings. Nvidia's up like 3%. You've had plenty of individual names running, and it's not just the mega caps. Definitely those are the ones carrying the index higher, but there's been a ton of like consumer staple stocks that have just been going gangbusters this year. So maybe it's an environment that we get some more stock picking, which is good opportunity for active management, getting away from the benchmark. Mm-hmm. There's a pretty good case for it right now. So
yeah, I agree.
Yeah. So those are the charts we want to hit this week. We appreciate the time. Joseph, you got anything to conclude with or parting thoughts?
That's it.
That's it. Cool. Well, thanks everybody. We appreciate the attention. We'll be on podcast again next week.